This is InvestTalk. Independent thinking, shared success. Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Wednesday, April 19th, 2023 edition, and I'm excited for this hour with you. There's a lot going on in today's market and economy, and I'm going to do my best to unpack it for you in a very straightforward manner, unbiased to my answers, and try to give you the frank assessment of how to make good decisions in this economy and this market. And I know there's been a lot of talk lately about the US dollar, and we've covered that a bit here over the past couple of weeks. But I wanted to start off with that because I think it's very important to try to break through the hyperbole and focus a lot on the facts and history, right? Because there's really nothing new under the sun. There's always the same things happen kind of over and over again. And issues that arise today have happened in the past and or have been discussed in the past. And this is really great because I went over to ChatGPT and I looked at the answer to what is called the Triffin's Dilemma. And there's something called the bank core. And I wanted to go over this answer because I think it's a great summary of how what our current system is like, what the issues are with it, and potential solutions, okay? Now, what is the Triffin's Dilemma? This is named after Belgian-American economist Robert Triffin. It refers to the conflict of interest that arises when a national currency also serves as the global reserve currency, like the US dollar. This dual role creates tension between the domestic monetary policy objectives and the international monetary system's stability. And this happens a lot when the Fed tightens its belts, right? The emerging markets don't do well because they have dollar-denominated debt and they can't pay off the debt because the dollar is too strong and their currency is weaker. That's what happens with the Triffin's Dilemma. But it happens the other way, right? With our dollar getting too strong and our exports becoming less competitive and hollowing out of our manufacturing base. Okay. Now, in the 1960s, Triffin argued that the country issuing the reserve currency, in this case, the United States and the US dollar, would need to run persistent current account deficits to provide the world with sufficient liquidity. This is called the Eurodollar market. Okay. Now, however, doing so would essentially undermine the confidence in the currencies as it would lead to increased debt and inflation. And that's kind of what's happened, right? And this could ultimately lead to the reserve currency's devaluation and stability in the global monetary system. Bancor, proposed by British economist John Maynard Keynes. If you're new to this game, John Maynard Keynes is one of the preeminent economists in the history of economists. Okay, and during the Bretton Woods Conference in 1944, which was this. He proposed it, in Bretton Woods Conference in 1944, and it's supranational currency designed to address Triffin's dilemma. It was envisioned as a unit of account for international transactions issued by a global central bank called the International Clearing Union, kind of like the IMF today. The main idea behind Bancor is to create an international currency that would be separate from the national currencies and not subject to individual countries' domestic monetary policies. This would help maintain global economic stability and resolve the inherent conflicts in Triffin's dilemma. Key features of the Bancor system include fixed exchange rates. Bancor would be pegged to a basket of commodities, ensuring stable exchange rates between national currencies and Bancor. Okay, this is kind of what I talked about. Remember, I was saying I think it's going to be a basket of assets, commodities and currencies. Number 2, symmetrical adjustment. Both deficits and surplus countries would be incentivized to balance their trade, reducing global economic imbalances. So it's saying with certain currencies getting too strong or too weak, that's what happens in the euro, right? The euro, being in the euro system, the euro gets too strong for countries like Italy, who have naturally weak economies, and makes their exports less competitive. Vice versa, in Europe, in Germany, the euro is weakened by those other weaker economies and makes the German exports more competitive. So Germany loves it, and that's why the pigs, remember the pigs from the European crisis in 2012, 2013, they struggled so much, okay? And now, number 3, international liquidity. The ICU, kind of like the IMF, would provide international liquidity by issuing or withdrawing Bancor as needed to facilitate global trade and maintain economic stability. Ultimately, the Bancor proposal was not adopted and the dollar was used. So, to summarize, I think that was a great summary of what I actually think, what is the next phase? Everyone says, oh, it's the yuan, it's going to be this other currency. It's something like the Bancor, likely to replace the dollar. Once again, probably not tomorrow, not next week, not next year, probably not even next decade. But by 2050, 2070, certainly possible. Okay. So I wanted to cover that before we dig in today. And we have a lot to cover, but I am here for you to answer your finance and investment questions and help you become a more successful investor. So you can call during our live show, 4 to 5 Pacific time at 888-99-CHART, or call that same number after hours and leave a message, and we will answer it on a future podcast. Now, my focus point today looks in the story behind this question. Can you transfer a mortgage to someone else? There are some rules around it, but we're going to discuss that potentiality, especially in a time where a lot of people, they're rate locked, right? You have a mortgage, 2.5%, 3%. I don't want to lose this. Well, you can potentially sell your house, right? And get compensated, right? You're going to get more money if you could transfer that, right? And someone else is going to, assume that loan, and instead of paying a 6 or 7% mortgage today. So, potential solution here. So we're going to look at that, but also I want to talk about the impacts that is going to of the banking crisis on economic growth. The IMF came out with a new prognostication or forecast for this year. So we're going to look at that. Also, volatility has reversed. Why? And is that a good thing? And then the 60-40 investment strategy did not have a great year last year, but is having a better year so far this year. So we're going to look at why and if that is to hold. All right. What else? We have some voice bank questions. We're going to talk about credit sweeps as well as CommScope holdings, and we have an iTunes review question as well. So I've got this all planned for this episode of InvestTalk, and of course, your live calls at 888-99-CHART. Now let's take a quick look at the market today. It was a modest up day. We opened lower. Small caps were up about 0.25%. The broad U.S. market was pretty much flat. Mid caps are down 0.1%. Overall, like I said, slightly higher. If you look at the NYSE, actually that was down 31 points. Yeah, small caps were up. That was really the strength there. But yeah, overall a flat day and into resistance. And I've said this before, not shocked to see the market kind of float higher in the near term. But ultimately, there probably will be more volatility this year and more buying opportunities. But liquidity has inflected positively, and you have to take that into account. Now we're going into a quick break. Please remember you can call anytime and leave your question on the InvestTalk voice bank. Or if you're listening via our live stream, you can call right now at 888-99-CHART.
In today's world, a variety of factors are affecting the stock markets. Serious investors know building a secure financial future requires hard work and determination. That's why now, more than ever, when it comes to the planning, execution, and maintenance of your portfolio, you need InvestTalk. With total downloads surpassing 50 million, each InvestTalk podcast should be one of your key financial planning and educational tools. InvestTalk is a free download, and hosts Justin Klein and Steve Peasley stand ready to provide their unbiased guidance and professional analysis developed from real-time data research and years of investing experience. 24/7, rain or shine, during smooth sailing or on rough weather days. The InvestTalk listener line is open and waiting for your questions. You set the agenda. Don't forget to call InvestTalk 888-99-CHART.
Every InvestTalk podcast is made better by your questions. So don't forget to call. And if you've never called, Justin and Steve are waiting now for your finance and investment questions. InvestTalk, 888-99-CHART.
Justin and Steve, hey, this is Andrew from Atlanta. I was trying to call you guys. I got a recommendation on a stock called COMM. That's CommScope Holding. They're suggesting that this stock may be at a bottom. I'm trying to learn, but I do lean on you guys for your analysis. Could you please look at this stock and tell me what your feelings are? Greatly appreciate the show, and I hope you guys have a great day. Thanks.
All right, this is CommScope Holdings, the provider of infrastructure solutions for communication, data centers, and entertainment networks. It provides back-end, basically technical infrastructure for digital video, IP television, distribution system, broadband access, infrastructure platforms, etc. So it's in the telecom space. The issue here is the debt. They have a lot of debt, $9.5 billion market cap, and free cash flow is now less than $100 million, trailing 12 months. So if you look at their times interest earned, negative 1.2. So it's basically in a debt spiral. And if you look technically, it continues to go lower. Let's see here. Pull that up. Yeah, I mean, it's at a 52-week low. This is now's market cap under $1 billion, debt over $9 billion. This is a situation where the market is pricing bankruptcy. So no, I would not buy this. It looks like it is headed for bankruptcy, and I would pass. And you want to be looking at companies that have minimal debt, not mounds of debt like this one. All right. Now let's play two in a row. This question came in earlier on the InvestTalk listener line at 888-99-CHART.
Hi, I just had a quick question about Rambus or RMBS. Wanted to see what your take is on that stock. Thank you very much. Love your show.
All right, Rambus. This is a name that's been around for a long time. It's had wild swings throughout its history. Let me go back to a monthly chart. This is one of the ones that was a darling of the .com era when it went public around in the single digits. It went as high in the .com bubble of 120 and change, crashed all the way back down to $4 in 2002. Meandered around, hit a high in 2006 before the financial crisis around 45, then went all the way down to $3-4 back in 2012, and has slowly edged its way higher, and now it's at $49 and change. So this is a semiconductor solutions provider. It offers high-speed, high-security computer chips and silicon intellectual property. So it has a lot of IP because it's been around so long, and it's a boom and bust stock, just like a lot of the chip names. So you can see here, this is a great example of how wild the fluctuations in profitability are in the chip space, and this is no different. It's definitely overbought in the near term. If I focus more on a daily chart, it is overbought. It's consolidating, so that's kind of a positive. If you're looking at its price sales ratio at 12 times, I think that's too expensive. Anything over 10 is usually too rich for my blood. And now it's at 12, especially for a name that has a history of wild swings in stock price and profitability. I think you're late to the game. And if you look at the trailing 12 months for cash from operations, it's now in a decline from last fall, 250 down to 230 million. So I'm passing on Rambus, just the history of it, and I don't like the valuation. It's way too expensive. Now we're moving into a break. I'm ready for your questions. InvestTalk is ready for you at 888-99-CHART. And remember, you can post your questions anytime with an iTunes review as well.
Each day, InvestTalk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for InvestTalk at iTunes. And be sure to include a brief question with your iTunes review comments.
888-99-CHART, 888-992-4278 is how you get through and ask your question. Now, our main focus point today looks into the story behind this question. Can you transfer a mortgage to someone else? And the answer is, it depends. Now, this is when you have someone else basically assume your mortgage, its current interest rate and its terms. And a lot of the federally backed mortgages like FHA mortgages, USDA, U.S. Department of Agriculture mortgages, Department of Veteran Affairs mortgages are typically assumable. But your conventional mortgage typically are not. They're typically due on sale clauses. Now, there are some caveats to that, which we'll get to. But it's something you should look at, especially if you are thinking about selling your home and you're saying, hey, I don't want to get rid of this 3% mortgage and go and transfer it to and go buy another house and pay 6 or 7%. But what if you could get even more for your home because someone else could assume that mortgage that you have, and that could compensate for that higher mortgage you might have to pay elsewhere? That's something to think about. Remember, there's trade-offs here in different circumstances that you have to weigh. And a lot of people don't realize that. They think that their mortgage can't be moved. Now, the buyer would still have to meet lender qualifications to be eligible. There's usually a home appraisal required as well. The home appraisal isn't required, is not required. And sometimes a mortgage can be transferred even if it typically is not assumable. And so a transfer might be allowed on a case-by-case basis for various reasons. One, if you want to transfer the loan to a spouse, child, or another relative, that's something to think about. Okay, maybe you have a relative that wants to buy your house, give it to your child, etc. Maybe you're going through a divorce or separation, so the house is under both of your names, and you're separating and getting divorced, and one of you is going to assume that mortgage, and the other one's going to move on. Or the original borrower dies, and the loan must be transferred to a surviving joint tenant or relative. That can happen as well. Or within a trust, right? So say you own it in you and your spouse's name, and you create a trust. That trust can now basically assume that mortgage because you guys are still the beneficiaries of that trust, okay? Now, eligibility criteria can vary by lender. And the buyer, once again, will have to do a credit check, income check, all of that. Now, so what you have to do is review the mortgage documents, see what the terms are. It's going to say it in your mortgage documents. Is it assumable or not? Or is it paid on transfer of the deed? Then you contact your lender to help initiate the transfer, see what the requirements are, and that varies by lender and loan type that you might have. And then, especially if you're going through some sort of divorce, inheritance, joint tenancy, etc., a lawyer might be helpful as well. Now, most states charge a real estate transfer tax whenever real property is sold or transferred. So this is a one-time fee, and you you may pay it, the buyer might pay it, it might split. There's some stipulations here, but you have to look into that and make sure you're not blindsided by that potentiality as well. So I think this is interesting. It's not something most people have had to worry about for a long time. We've gone through this period of 35, 40 years where interest rates have just gone down and down and down, mortgage rates have gone down and down and down, and usually the seller the seller had a mortgage rate that was similar or higher than the buyer, and so the buyer is better off just going to get a new mortgage. But now we're in this era where interest rates they're not going down, right? It's below 3% probably anymore. They may vacillate here between 4 and 7% for a long period of time. That's potential. Or they might continue higher. I think this is a really important topic to think about, to pass on to friends, family who have mortgages and have homes that maybe they feel stuck in. Right? They're rate locked, rate trapped, and there's a potential out here that can compensate them for having and be able to lock in that real low rate. So I wanted to highlight that and keep that top of mind for you. Now, in the next InvestTalk, the story behind this question: are we in a freight recession? At least one major trucking and transportation company reported first quarter profit and revenue that fell below expectations. It is a challenging freight environment with deflationary price pressures for an industry that continues to face inflationary cost pressures. And this is something I remember Zim Holdings. This is one that everyone was calling on because it looks super cheap based on backward-looking PE ratios, but it continued to go lower because earnings continue to go lower. And remember, the market is forward-looking, so this is what you have to look at. It's always investing through the windshield, not the rear view mirror. So that's something we're going to talk about tomorrow, and this is a great topic for that. But for now, I'm Justin Klein. I'm ready to take your questions live at 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. So as long as your questions involve the stock market or general investment topics and definitions, we set no limits. You, the caller, get to chart the course for each InvestTalk podcast. Justin and I are ready. Are you? Call with your questions anytime, day or night, 888-99-CHART.
Hi, Steve and Justin. This is Kevin calling from La Crescenta, California. I have a question about Credit Suisse. I was looking at some of the corporate bond offerings, and I saw that Credit Suisse, which was near bankruptcy and bought by UBS, this year has a lot of bond offerings that have very high yield to maturities. And I'm wondering what the impact or what the risk is now with those. Did UBS also buy all of those, and now are the ones going to be covering it, or are they going to be lost at some point, or the risk is there? I appreciate your thoughts and information. Thanks.
This is a good call because especially if people are buying corporate bonds, you need to understand how these mergers work. And what happens when the company like UBS is buying Credit Suisse, they're assuming that debt. So it might still say Credit Suisse because that merger hasn't fully gone through. And sometimes even after it goes through, the bonds still say Credit Suisse or the old company. But ultimately, your counterparty, the corporation that's backing those bonds, is UBS. And UBS just got bigger. And they assumed a lot of problems, right? Credit Suisse had its problems. And maybe they paid a good price for it. Maybe they didn't. We'll see in time. But ultimately, UBS becomes a bigger risk, becomes a even bigger company, even more important to the country of Switzerland. It's where it's domiciled. And that's what you're buying. You're buying a bond, a UBS bond now. You buy a Credit Suisse bond. It's not a Credit Suisse bond. It's a UBS bond. And you see what happened to the COCO holders, the contingent convertible bond holders. They were not treated well. When companies get nationalized or there's some sort of regulatory forced merger, there's haircuts that happen with equity holders, potentially bond holders, and that's the risk here with UBS. Now that's likely down the line. I don't think anything's going to happen to UBS in the near term, but that's what you're buying into, is a global bank that now just swallowed another global bank that has a lot of debt and a lot of problems, and maybe they can right the ship, or maybe they can't. So that's how you want to look at those bonds that might still say Credit Suisse, but ultimately they are UBS bonds. All right. Now let's touch on a report from the IMF, and they downgraded the economic growth of the United States, their projections for economic growth, from to 1.6% this year, down from 2.1% last year. And they're saying that there's about a 1% reduction in lending capacity in the United States from banks because of the recent banking crisis. And that is ultimately going to shave off about 0.44 percentage points of GDP growth this year. So going from a little over 2% down to about 1.6%. Now, they do see the global economy growing 2.8% this year, a slowdown from 3.4% last year, mainly helped here by the growth in China and the reopening and reversing of those lockdowns. So that's certainly going to help economic growth over there. And then other emerging markets are continue to heal, especially with the dollar kind of reversing since the fall. Now, since the banking crisis, the 25 largest U.S. banks gained $120 billion in deposits. This is according to the Fed data. And if you were below the top 25, you lost $108 billion over the same period. So there's likely to be continued, the smaller banks are probably going to continue to struggle. There's going to be more consolidation. And frankly, it's kind of rare. Our system is fairly rare in the world. Most banks or most countries have a handful of very large banks. And there just tends to be consolidation over time because of things like this, of potential runs on the banks. And the smaller banks are more susceptible to this because of their variability in their deposit base and their business model. And you can see that with Silicon Valley Bank. Now, banks are also going to have to start paying higher interest rates to their depositors. That's going to shrink their net interest margins and potentially force them to pull back in their lending. And some economists are saying there will be a recession this year. I actually do. I'm kind of in that camp that we'll hit a mild recession later this year, probably precipitated by the next kind of next major issue, next thing that's going to probably create credit problems, and that is in the commercial real estate sector. And the IMF kind of agrees, and they say they're facing lower property valuations and struggling to find tenants after the pandemic shifted work away from office buildings. And these confluence of factors of higher interest rates and structurally lower demand for commercial real estate means that real estate valuations are going to be lower, there's going to be defaults, and ultimately bankruptcies in parts of that market. And so central banks have a trade-off between fighting inflation and protecting financial stability. That's what the IMF says. And in my mind, it's going to be pretty clear that by the second half of this year, inflation is going to be not an issue, at least the headline numbers. Now, longer term, I think inflation is structurally higher. But when you ramp interest rates so fast, so high, you're naturally going to get a deflationary impulse. And that's what you've kind of seen over the past year or so. And, you know, with the M2 shrinking, and ultimately that's a lot of monetary tightening to really rein in inflation. And so I think that's the longer term issue, is how do they pivot without letting inflation kind of ramp back higher. And I think that's what you're going to see this decade is, yes, we're going to have times where inflation is going to pare back down to 1 or 2%, but it's not going to stay there for very long, most likely. And that's ultimately the longer term, I think, risk to markets. All right. Now let's keep things moving and pivot back to the InvestTalk voice bank at 888-99-chart.
Hello. Thank you guys for the wonderful show. It's very entertaining and very educational, so thank you so much. My name is Freed, calling from the state of Washington. I'm calling regarding the stock symbol IIPR. Owned it for about a year now. It's been up and down, up and down. Kind of getting impatient with it, and with interest rates rising in this industry, not really a bellwether industry. I was wondering what your guys' opinion is on this. I know you guys have held it in some of your portfolios. Trying to figure out how to move forward. Thank you so much.
Yeah, this is IIPR, and this is a cannabis REIT. They lease out cannabis spaces across the United States and to grow facilities, to dispensaries, etc. And they've struggled recently, or at least the price has struggled. The business is fine, right? Cash from operations is still growing now at a slower rate than it was a year or two ago, but still growing. You have 20% funds from operation sales growth year over year, 28%. Sales 20%, funds from operation up 28% year over year. So that's fine. They are having some issues with some of their tenants, but they're finding replacements for them rather quickly. So I don't really see an issue here. Minimal debt for its size, and recently you're starting to see a pickup in volume. So I think this is being weighed down by those the commercial real estate market as a whole, but this is obviously not going to be impacted by the work from home environment. And ultimately, there's some longer term tailwinds. So I still think it's a good value. All right. Now, when people take the time to leave an InvestTalk review on iTunes, we like to thank them for the courtesy by getting to their questions quickly. Randall 1951 says, "My question concerns the term revert to the mean. I think I have a general idea of its meaning, but how is that applied in investing? Example, I bought Exxon at 32, and now it's at 116. I doubt it goes back to 32. So how do I determine the mean? I mean, I want to buy more, but like everyone else, I don't want to overpay." Okay, so reversion to the mean is simply looking at the long-term trajectory, the average return of the stock or the asset class. You could just say the asset class in general. Rambus is a good example. We had that call before about Rambus and how this has wild swings over its history, right? From the low single digits all the way to $100 plus during the .com bubble, then rallied all the way to 40, then back down in single digits, now back up into the 40s again. And so what you can see here is that there is volatility, right? So the mean is the average. So if long-term equities, say, return 10%, but that's not a smooth ride. Equities aren't like a bond. You're not just getting 10% every single year, and that's how it goes, right? There's great variability to that. And so what happens with a lot of people is they don't pay attention to the longer term trends of a particular asset class or a particular company. And they think the current state of recent returns or recent business success or failure is going to be extrapolated out forever, right? Something goes up 30% in a year. They think that 30% is just going to be this consistent, likely trend. No. The answer is probably something that's more reasonable. Okay? And so there's some sort of mean trend. And you can look at some, even just longer term names, you can look at Apple, right? Stocks get overbought and they revert back to their longer term average of growth. So that's really what it's about. Now, will Exxon revert down to 32? No, that probably doesn't mean that they're going to revert to 32. But maybe they retrench back to 80, right? And that's maybe the longer term mean. If you do if you create a line between the charts, the mean is probably going to be closer to 100, right? Now it's at 116. So does it get back to 100 at some point? Maybe. Remember, it's like a pendulum. The market's like a pendulum. Stocks are like a pendulum. Asset classes are like a pendulum. How often is a pendulum in the middle? Only for a very brief second. It's usually swinging one way or the other. And then it gets too far, and then it reverts back to the middle. And it typically goes the other way, too far the other way, because sentiment, because people are emotional and they dump things because, oh, it was down 10%. I want to sell. I want to get out. That perpetuates more losses and more people get out. And sentiment gets worse until it hits an inflection point. All the sellers, all the weak hands are out, and then it turns the other way. That's what the pendulum is, and the market is like that. Asset classes are like that. Why? Because we are emotional beings. And sentiment shifts. And that's what creates reversions to the mean. Great question, though. Now, Steve and I have been telling you for a while now that we are in a new market environment. Cycles are a natural part of everything in life, that pendulum I just talked about. And we have shifted, right? I talked about how we get to a certain point. For example, in commodities, we got very one way, very oversold, very low allocation to commodities just a handful of years ago. And now it's starting to inflect the other way. Now, how far does it go? TBD, but it's likely headed in a positive direction. Until one point, there's probably overzealousness. There will be naturally in that particular asset class, and then that will be a time where you want to be trimming your positions. So that's how you have to understand these ebbs and flows. Otherwise, you are going to be a product of that emotional swing. And so if you need help understanding whether you're positioned correctly for this new swing of the pendulum, I encourage you to reach out to myself or Steve Peasley at our company, KAPP Financial, where we operate the same philosophy, which is independent thinking and shared success. And we provide unbiased guidance, both on and off air. And we practice parallel investing, which means we invest right alongside our clients. So if you want to take advantage of our free portfolio review assessment, I did 3 of these today. Via telephone, GoToMeeting, just head over to investtalk.com, click on the portfolio review button, and just fill it out, and we'll go from there. Or you can call our office at 800-557-5461. Speak to you for a short time, figure out where you're at, where you're going, and whether you're on the right path, and get your portfolio optimized. Now, next up, let's play another caller question.
Hi, I was wondering if you could give me your opinion on Industrial Logics Properties Trust, ILPT. Thanks very much. Bye.
ILPT. Ooh. Okay, this is a REIT that owns and leases industrial and logistic properties throughout the United States. Trading at $2 per share. Let's say, I'm assuming this is a bankruptcy candidate. Let me look at the data here. Yep. About $4.2 billion in debt on its balance sheet. Its times interest earned is negative. Okay, this is the second question today that companies that are likely bankrupt, trading at $2, $3, $4 a share. And I haven't said this in a while, but I'll hammer the message home right now. There are more companies trading the single digits that are expensive than there are companies trading over $100 per share that are expensive. Never look at the dollar amount that a stock is trading at and think that's cheap or expensive. It's irrelevant. It's all in relation to its earnings, its cash flow, etc. So just because they look cheap, right, trading at $2, $3, no, these stocks are expensive. You know why? Because they're about to go bankrupt and they're going to be worth $0. So if something's worth $0, the equity's worth $0, and it's trading at $2, it's drastically expensive. There are no companies trading over $100 per share that are on the brink of bankruptcy. Okay? Now we're heading into our final break, and I'm ready to help you achieve your own version of financial freedom. So give me a call now at 888-99-CHART.
The stock market is constantly changing, and serious investors know that they need to modify their portfolio assets to fit the times. And now, with more than 50 million downloads, Justin Klein and Steve Peasley reaffirm their commitment to providing unbiased finance and investment guidance here on InvestTalk. 888-99-CHART.
Hey, Steve and Justin. Thank you so much for the show. I have a question regarding mining and mining stocks. I don't own any mining stocks outright, and I'm curious to get your thoughts on two stocks, some super big companies, BHP Billiton and Rio Tinto. I'm thinking about buying some stocks in both of those companies, so would love your thoughts. Thanks again for the show.
Are you looking at BHP out of Australia and Rio Tinto out of the United Kingdom? Now, Rio Tinto is a globally diversified miner, but its dominant commodity is iron ore and to make steel. And they do have exposure to copper, aluminum, diamonds, gold, industrial minerals, etc. A very large company, $112 billion market cap. Now, BHP also globally diversified in iron ore, copper, and metallurgical coal. And so that's what you're getting here is something that maybe is a lot more less dependent on iron ore and has more copper and metallurgical coal, which I like. I like the metallurgical coal side. And I'm gonna say, if I'm gonna pick one, I like BHP. It's once again more diversified. Its profitability is a bit more consistent, and its relative strength is also a bit better. So if I'm picking one, I'm picking BHP. All right. Thanks for the call. Now let's touch a bit on volatility. And what's interesting here, it's something I follow. If you follow my weekly market wrap-ups on YouTube, or if you're a client and you tune into our office hours every Wednesday, you'll know that I go over the volatility indexes, and not just the VIX, but also the MOVE index, which is a measure of bond market volatility. But all of these volatility indexes from equities, right? The VIX is on equities, as well as currency volatility and bond market volatility, have come back down over the past month or so after spiking during the banking crisis. And what was always interesting to me during that crisis was the VIX didn't really break out. Okay. Its high back in middle of last year was in the mid 30s, and it actually made a lower high in September, and then it peaked out in around 30 just recently, and now it's down to 16. Okay, and so that was a tell to me that I don't think equities were going to inflect a lot lower, because volatility wasn't picking up on the equity side. And then the MOVE index, it did break out above 150, which is a worrying sign, and was there for a handful of days, but reversed by the end of March and has fallen back down to 124 at the close today. So that calm there is helping asset prices overall. It shows that traders aren't bracing for wild moves in any of these markets, and more focused on the normal topics, which is earnings, right? Not some systematic breakage of the system. And this is what I've talked about for a while, is that central banks are going to come in. They can't afford an 08. They don't want a deflationary bust. They will paper over the problems, and they will create lending facilities. They will do things to quell the volatility. Now, one day, maybe the market takes away their ability to do so, right? Takes away the printing press. But the system is the system, and the Fed and other central banks are the head of the snake, and they kind of control things. So they're very well incentivized to calm down any major spike in volatility. And that's what you've seen as of late. And the fact that they're making consistently lower lows indicates to me that liquidity is inflected positively from the lows in the fall. Doesn't mean you can't have volatility going forward, but definitely something to keep an eye on to see where it heads. And as long as it remains relatively low, positive asset prices are ahead. Now, I'm Justin Klein. This completes another InvestTalk program. Steve Peasley and I thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And follow us on InvestTalk on our social media platforms as well. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461.